All right, so there's still a lot of talk on a recession coming in 2024, and for starters, nobody knows when or if or how the market will respond exactly. So I would preface everything I say with that. But we've seen a decent pullback in most oil and gas companies, and if we see a recession, which it's looking like we will, the real question is just how bad it's going to be. That signs seem to point to it'll be pretty mild. In fact, it may even be very, very mild, but nobody knows, and nobody knows exactly when it's going to be. The bond market is signaling cutting as early as, I think, March, so we will see how that goes. But it's looking like the recession probably kicks in either Q3 or Q2. And then we go from there. I think that the Fed cuts and we finish the year even, if not up. There'll probably be I would guess, a 10 to 20% pullback in there. I don't think it'll be anything too significant. But again, oil is the big key. But the one thing about oil is that OPEC could cut production to maintain prices, but they can only technically cut so much. And there's nothing stopping someone from breaking ranks necessarily, right? So it's kind of tough to see how that will go. But if we get lower oil prices than they are right now, which they're already lower than they've been, at least on the low end of the last couple of years or so, we're going to see an even deeper correction in oil and gas companies. And again, oil and gas companies are cyclical, meaning most of them are not long-term, 20, 30-year holds. But they are definitely good trades, at least for the medium term, right? I'm not saying long term or short term. Nobody knows what's going to happen over the next month or two, but I think if we get a nice dip in oil and gas companies, I think it could provide a very good buying opportunity. So I'm going to give a handful of names. I've talked about all of them before, so nothing is new here, but I wanted to go over the ones that I own, and again, none of them are significant positions. So again, do your own due diligence, all that stuff. But again, the first one is ARLP. This is one of the smaller ones on the list. Again, only a $2.46 billion company. Again, 24% free cash flow yield, though, which is just crazy good. They're currently paying what is technically a 14% dividend. And again, with a 24% free cash flow yield, they can easily pay that. But again, you don't buy for the dividend, right? That's something you always want to keep in mind. But again, when you look at it here, they're at roughly a 50% payout ratio, which is just crazy good. And again, they've been growing that dividend ever since the troughs of 2020, and they've had a dividend that was back at the end of 2015. The dividend was a tiny bit lower than what it was here, right? So again, a lot of this is dependent upon oil and gas prices. So again, if we see a significant dip in oil and gas prices, the dividend probably goes down. But again, you also have to keep in mind that the price will go back up at some point, right? So again, if you'd have bought this company back in the troughs of 2020, for example, you would literally have like a 90%, upwards of 100% yield on cost. If you'd have bought it right at the bottom in 2020, you would have 100% dividend. Right? So again, that's why you want to buy these companies when the market is down. But again, they're not long-term holds, at least like decade long-term holds. I think that oil and gas will do good over the next decade or so. Maybe not as good as the market, but I think there'll be some really good buying opportunities in there. And 2024, I think, could provide that. So this is one of my more favorite ones. The next one is NRP, Natural Resource Partners. Again, talked about it before. I think it's a solid company. Again, this is another small one. Again, the dividend's not nearly as high, but again, you also want to keep in mind this is a very good earnings yield. This one's actually basically at a 52-week high, which is kind of surprising. But nevertheless, if we see a correction, I still think it will correct. So keep an eye out there. The next one is EOG Resources. This one's a little bit bigger. Again, they're basically right in the middle of their 52-week range, actually. Again, this one's a $71 billion company. Again, this one I like as well. Again, they're a lot more steady on their dividend. They are growing it very nice, but if you keep in mind here, they've never cut their dividend going back a decade, right? They've never cut it. So this one's definitely going to be more stable than the past two. but again, it's not as high, right? But again, the payout ratio is still 27%. So you get a 3% yield that, again, and not to mention too, let's say the stock corrects down to 110 or 100, that yield's going to be probably 3.5%, 4% maybe even, right? So that's why you want to keep an eye on these companies, is that's when you're going to start to get those nicer dividends when the price comes down, right? You just need to make sure it's sustainable, because it isn't always going to be sustainable. The next one is ConocoPhillips. Again, all of these I do have small positions in. Again, this one's got a much lower dividend, although they're buying back a lot of shares. I mean, if I go into their financials here, I seen they were buying back a ton of shares, right? Let's check and see here. I mean, they bought back 8.9 million shares last year and 3.4 the year before that. I mean, they haven't even issued a new share since 2014, right? So they're not paying out nearly as much in dividends, but their goal is buying back shares, and not only that, they paid down a lot of debt last year as well. So again, they're more or less going the I'm completely blanking. Occidental Petroleum. That's kind of their way of going about things, is that they don't pay as high of a dividend, but they buy back a lot of shares, they pay down a lot of debt. And that's exactly what they should be doing when times are really good, is paying down the debt, right? And again, they are growing their dividends still. Over time, they're still growing it, right? I mean, they cut it massively back in 2015. But again, ever since 2016, they've been growing that dividend actually fairly nice. They've more than doubled it over that time. So that's another one to keep an eye on. The last one here is CNQ, Canadian National Resources. Again, another very solid company, 4.6%, although that payout ratio is around 60%. So this one is bordering. This one's also near the 52-week high. Again, if we look at the financials on this one, again, they are consistently buying back shares. Again, they haven't issued a new share in 5 years. They're consistently paying down debts, especially over the last couple years. So again, that's what we want to see for these companies. Another very important thing that I didn't get into in any of these is you want to buy companies that have good balance sheets, right? Good balance sheets are going to be very, very, very important over the next decade or so. In a higher rate environment, companies that have poor balance sheets are going to have to pay more to service their debt. And what does that mean? They're going to struggle more. It's going to be harder for them to get by. They're going to be able to distribute less cash to shareholders, right? So keep an eye on that. Always check out the balance sheets. Every single company that I brought up has at least a solid balance sheet, in my opinion. So again, that's another thing to keep an eye on. But anyway, I wanted to make a video about this because I think that, again, there's going to be a good buying opportunity in 2024. Again, just a prediction, but that's just what I'm saying. So anyway, if you liked the video, hit that like and subscribe, and stay tuned for more.